warm welcome to Global Mantra Outlook 2014, a special show that profiles prominent fund managers from the City of London and gets their views on the global market environment. My guest today on the show is Kevin Gardiner, who's Chief Investment Officer for Europe at Barclays. Kevin, great to have you on the show.
My pleasure, thank you.
Well, let's begin by understanding your assessment for 2014. What are the investment themes that you're outlining for the new year?
Well, we're thinking that 2014 could be the first year in a while in which we've got reasonably synchronized economic growth across the major parts of the developed world, at least. So for the first time, I think, since 2010, we're expecting to see the UK, the Eurozone, Japan, the US, all moving forwards together. So growth will be one of the themes for next year.
What else are you watching out for, especially on the DM versus EM trade?
Well, absolutely. The emerging markets have underperformed quite markedly, both in terms of bonds, currencies, and of course equities in the last 6 months or so. In fact, they've underperformed really for the last 3 years, taking the period as a whole. At some stage, if we're right and the structural attractions of the emerging world are still very much intact, and we think they are, at some stage it will be right to raise emerging markets to a bigger position in the portfolio. Maybe it will be time to go overweight emerging stocks again. We're hanging on our seats for the time being, because one of the other themes that's going to be very relevant to this, we've got economic growth, we've got the question about emerging markets, the tapering of the Fed's quantitative easing. The beginnings of monetary normalization will be tremendously important to the emerging market trade.
Where do you expect this Fed to start tapering?
Well, we're currently expecting the Fed to start tapering in March. I said currently very carefully because it's data dependent. If the economy turns out to be stronger than the Fed or the markets are anticipating, it could happen sooner. If it's weaker, it could happen later. As we're looking at things, though, the question for our clients is not so much which week, which month it will occur in. It's going to happen at some stage, we think, probably during 2014. And the key thing to focus on is that the impact of monetary policy on some of the short-term market moves shouldn't obscure the underlying story, which is that the economy is recovering, and that's good news for most portfolios, not bad.
But what if the data doesn't pan out as expected? What if, because this year you're going to be looking at the downgrades coming in on growth, given the government shutdown, there's going to be some revisions, so sub 2% perhaps, or 2% growth for this year. What if growth doesn't kick in as expected for 2014? But then the Fed is faced with the problem of the debt rising on their balance sheets. So, they still have to go ahead with tapering while growth just stabilizes, but that doesn't pick up. Is there a scenario where the Fed will go ahead with tapering despite data not being supportive?
My guess is probably not. I think if the data disappoint, if growth doesn't come through, and you're right, there is a risk that that could happen, of course. If that happens, I think the Fed probably won't taper, and they will continue to buy bonds for the foreseeable future. That
can
in
they
itself,
afford to do that?
They can afford to do that because it's not about affordability, it's about the ability to create money, literally. And they can do that as pretty much as far as they want to. Whether the longer term consequences of doing that make sense is a moot point. And personally, I'm a little surprised and disappointed that the Federal Reserve already hasn't had more confidence in the underlying health of the US economy to actually begin tapering already. But they can certainly taper for longer, and at the margin that would mean that we'd probably have to be a little bit less bearish of bonds and a little bit less bullish of stocks. But our central view is that the underlying resilience of the US economy is actually stronger. It's greater than most people think. So we're expecting, if anything, the possibility of growth accelerating next year, not falling short.
But what would be the market's reaction to such an event? And would you be surprised if the Fed actually tapers in December?
We'd be a little surprised. My job is all about surprises, and if I said that I'm never surprised by anything, I would be kidding you. So we would be a bit surprised. In the scheme of things, would it be a dramatic surprise? No. Because we thought just a few short months ago that the Fed would have started already by now. So December wouldn't be a huge surprise. In the short term, that would create a sell-off, some volatility in markets. But longer term, as I say, if people focus on why the Fed is tapering, it's because the economy is improving. That's the thing to hang on to.
But, the last time, especially in July, August, when there was this expectation of tapering, emerging markets sold off in excess of 10–15%. Do you think that kind of reaction is what one would expect this time around? Or, we've done the test run, so to speak, of the news, so the markets would be a bit better prepared for an event like this, and the correction would be perhaps not as exaggerated?
We'd hope so, and emerging markets are cheaper now. So valuations in most emerging markets have come back. Currencies are lower, they're more competitive, better able to withstand some sort of external shock. But just in the last couple of weeks, we've seen occasions when economic data releases have been stronger than expected, and we've seen emerging markets sell off again, even though they already sold off a lot in the summer, because people were starting to think that maybe tapering could happen a little bit more quickly than the March that we'd all been penciling in. So we'd be optimistic it won't be quite as sharp as in the summer, but it would be silly to say that there would be no effect.
But isn't the market bracing for a correction? Because even valuations, especially in the US markets, are, as some would say, at sky-high levels, or the valuations compared to 2009 are almost 3 times.
Well, we certainly think that some sort of sell-off or correction is overdue. We haven't had a meaningful setback in the US stock market for well over a year, I think. So in a
and you've been very bullish about the US
We've
markets.
been pretty positive on it. It's been our favourite stock market, along with continental Europe. We also like it in the last year. So we've been pretty positive, but ourselves, we're expecting some sort of technical correction. The issue is, will it be a big fall and will it be a lengthy fall? And our guess is that it might be neither of those things, because actually we disagree a bit with the point you made there. We don't think valuations are sky high on the US market. We think they're actually pretty unremarkable. And some of the valuation metrics that we see people using, we find all sorts of weird and wonderful things being rolled out, such as Tobin's Q ratio, cyclically adjusted price earnings ratios, which depend for their accuracy on data that are more than 100 years old. We're not convinced that those valuation metrics are telling the right story.
Also, how much do you think the tapering event would spark a rally in the dollar? How much do you think the dollar can go up from here?
Well, we think the dollar is probably going to perform pretty strongly whenever the Fed starts to taper, but obviously if it starts to taper a bit sooner, then the dollar could be stronger a little bit earlier than we're expecting. We're thinking effectively that the US currency doesn't always have to be a safe haven currency. Sometimes it's a pro-cyclical currency, and it can go up because the US economy is performing strongly, and because US stocks, for example, might look attractive investments. We saw that in the second half of the 1990s, and we're expecting a similar sort of switch in the drivers of currency markets to happen now.
So would 2014 be a year of outperformance from DMs over EMs again?
At the moment, we're thinking it probably will, but that's one of the areas. So we're going to start the year preferring developed markets to emerging markets, but we wouldn't be at all surprised to see us having a rethink as the year progresses. That does depend on the timing of tapering. It also depends, to be honest, about the prospects for the short-term business cycle in some of the emerging markets. Some big emerging markets have really disappointed with their current account positions, with their inflation numbers, with their growth numbers. It also depends on structural reform in some of the emerging markets. So let's see what happens there, and we'll cross that bridge, as we say, when we come to it.
What do you see driving money into emerging markets at this point in time? Because so far the story had been one of liquidity and yields, right? But now the expectation is that money will chase growth. Do you think the markets will be in an adjustment phase where liquidity first gets withdrawn on account of tapering, and then wherever there is potential and recovery or growth signs coming in to independent economies, money then flows back into those markets?
No, I think that's a very good way of putting it. It applies not just to emerging markets relative to developed markets, it applies within developed markets even to the forces driving stock markets. So we think 2014 will be a year of transition, if you like, away from liquidity or PE expansion towards growth, underlying earnings profitability at large companies, and the emerging trade will be part of that. And eventually I do think people will come back to emerging markets for the right reasons, which is that the structural growth appeal of those markets is actually pretty compelling. But as you say, liquidity moves in cycles, and recently people may have been buying emerging markets the last few years perhaps for the wrong reason.
Do you think that the tapering announcement could bring about a similar sell-off, 10 to 15% in emerging markets like the one we saw in July, August?
We're optimistic it won't be quite as marked as that, because valuations now are lower, currencies are lower, so the emerging bloc is more competitive and better able to withstand an external shock. But it would be silly to rule out a setback completely.
Talking about emerging markets now, do you think that post the tapering event, it's going to be more the local factors and how each emerging market handles its local problems that will drive interest going forward?
I do, eventually. The qualifying point there will be that, so tapering happens. As tapering is happening and in the immediate aftermath, people will remember that tapering is happening because the US is growing. Yeah. If the US is growing, it's importing. Some emerging markets such as Korea, South Korea, Southeast Asia generally, some developed markets actually do well on the back of US growth. So they can do quite well, even relatively, even during the tapering. But eventually, as you say, afterwards, further down the road, we will, I hope, focus once again on the attractions of the individual economies.
What are the chances of tapering not happening in 2014? And would you be disappointed if that happens?
I think the chances of it not happening, that it's always possible that something unexpected could occur, maybe 25%. It doesn't happen. So a material chance. Personally, I would be disappointed, because what it would mean is that the US economy is not growing as quickly as we think it's capable of. And that's the main reason for staying positive on many of the assets in our clients' portfolios. So if the Fed isn't tapering because the economy is not growing quickly enough, profitability won't be what we think it would be, and our clients' portfolios won't do as well as they could do.
So there could be a reason of a sell-off, even if that were not to happen, if tapering were not to happen?
Of course, of course. And in financial markets, as you know, as well as I do, there are always possibilities. If you can't see the market moving in a different direction to the one that you expect, you're not doing your job properly.
But emerging markets have largely been led by liquidity and, you know, the expectation that tapering will be postponed. Do you think that that would be reason enough to fuel markets higher from here, emerging markets especially? Would the risk on trade get extended?
No, I think the liquidity fueled move into emerging markets, I don't think that's the best reason for buying emerging markets. And so if the Fed does taper more slowly, the liquidity seems as if it's continuing, I think any rally based solely on that would be a relatively unhealthy one. We want to be investing in emerging markets on a long-term basis because we're happy with the underlying characteristics of the companies we're buying and the economies in which we're investing, not simply because the Fed is buying bonds. That's not the best reason for buying.
All right. Within emerging markets, which are the markets that you like at this point in time, and which are the markets that you're completely avoiding?
Well, on a longer term view, our feelings always are going to be most constructive on Asia as a region. I say always, that sounds a little bit definitive, but we feel pretty strongly that Asia should outperform most other blocks in the emerging world, and growth-wise, even the developed world on a longer-term basis, essentially because for the foreseeable future, 3/5 of the world's population will live in Asia. In increasingly integrated and open capital markets, where economies themselves are integrated and labour and information technology flows right the way across the world very, very easily and increasingly so, why shouldn't the bulk of the world's economy move to where the bulk of the world's population is? That's in Asia. Another reason is that already, even before we get that structural growth being fully materialized, if we're investing in Asia, we can buy companies in the primary sector, the intermediate sector, in the consumer finished goods sector, the services sector. If I go to Latin America, if I go to Africa, if I go to the big Eastern European emerging market, I'm focused very much on one or two tiny or narrow sectors. So we can be diversified.
So even though you're talking about structural growth coming back into these markets, right now they're being faced or plagued rather by growth slowdown and downgrades on the growth fronts. You know, you've seen estimates being revised lower for 2014, 2015. How does that then tie in with your outlook on when you would perhaps change your view or go overweight on emerging markets or Asian markets, right now your view being neutral?
Well, some of those growth disappointments will start to go away when the Fed tapers, because if the Fed tapers because US consumers are buying more stuff from the rest of the world, then people will start raising their forecasts for emerging exporters in Asia, for example. So some of that growth downgrade will stop.
Of course, the other key risk is also inflation. So it's not just handling slowdown in growth, but also tackling a slowdown in real growth, adjusting for rising inflation. So how does that get adjusted in your view? How do you accommodate that risk?
Well, if inflation does start to accelerate, that's something to keep a close eye on, because the reaction of central banks could actually slow the underlying growth rate in their economies. And in the last year or 18 months, inflation has been a disappointment in Brazil, in Turkey, in India. It's a frustration. To some extent, inflation, if you like, is simply, it's almost like the oil or the a necessary byproduct of economic growth. So it's not always quite as bad as it looks, but the mix of growth and inflation sometimes can disappoint, and that would be a concern.
Coming down to India, and now it's one of the markets that's been kind of clubbed in the fragile five. All the developments over the last 6 months, do you think they have been material in nature to change your outlook on India, or is elections, the key factor that will determine your outlook going forward?
That's a great question, and I wish I knew the answer, because we like India's potential, which is fantastic. In many ways, I think its potential is greater even than that of China. But whether it's the election or the non-election, the political process sometimes makes structural reform very difficult. And although, for example, the new central bank governor has shown that he's quite willing to introduce competition to the banking system, which is great, structural reform, however it comes, whichever government delivers it, is what's needed to really catalyse the long-term potential that India has.
But what are you expecting from the election event?
I'm expecting pretty much little change in the underlying pace of structural reform, which is why we're not placing a big positive bet in favour of India for the time being. We would love to, because that potential is terrifically exciting, but often the Indian market moves up, it gives some back. The currency can be very volatile alongside the stock market.
But doesn't a weaker currency and attractive valuations build a case and a compelling one to look at India favorably right now, or markets, other emerging markets, which also have that dual benefit? No,
that's right. The currency does make India, and currencies generally that have fallen, make other emerging markets also more competitive. India is very rarely a cheap market, though. As I'm sure you're aware, the prospective price to earnings ratio in India usually is one of the highest in the world, not necessarily just within emerging markets. So it's very, very unusual for PEs in India to trade at particularly depressed levels. So in local currency terms, if you like, there is already quite a bit priced in, and that currency volatility can cut both ways, particularly when the currency is not always as liquid and as freely tradable as investors might want it to be. Will
2014 be, in that sense, a testing period for India to prove it?
I think it will be, and I would love to be proved wrong. I would love to see a new government introduce supply-side reforms that really get the economy moving in the way that we know it can.
What do you expect on growth as well as inflation? Because right now food inflation is a sticky part in India. Like I said, growth downgrades have been coming in, pegging growth between 4 to 5%. Are those reasonable numbers to go by with, or do you expect things to change? I mean, what are your own estimates on the macro side in India?
I think those are reasonable numbers in the short term. Longer term, we'd be optimistic that the trend rate of growth can move back up a little from the disappointing levels that it's reached recently. Now, of course, 4 to 5% by developed world standards is fantastic, but India needs to do better simply because it's got so many more people to look after, and so its standard of living needs to rise so much more rapidly than that elsewhere.
Do you think that emerging markets need to continue with rate hikes? I mean, we're seeing rate hikes in India, in order to control or curtail inflation. Do you think that would continue, or, once there's more stability in the currency, that would stop?
Well, that's where we come back maybe in the short term to that tapering debate, because it depends to some extent on the outflow of portfolio funds from emerging markets as the Fed begins to raise its interest rates. And if that occurs in significant size, currencies even now might come under further downward pressure.
Despite the rate hikes?
Despite the rate hikes, even now they could come under further downward pressure. You could yet see the need for further rate hikes. But we'd be cautiously optimistic that the outflows will not be as pronounced as they were last summer. And as a result, we think we're through the bulk of this rate hiking cycle.
And do you think that stepping into 2014, we would still brace ourselves for a weaker EM currency environment because the dollar would be stronger?
We're starting that way, yes. There'll be some exceptions. Even if we're right about the dollar being strong generally, there will be some emerging market currencies which are able to buck that trend. Probably the Chinese currency is the most visible one, but even there, that's more of a long-term story rather than something that we expect to be banging the drum about early in 2014.
Would there be some arrest on the current account deficit side, given that the expectation on gold as well as oil is that in 2014 the prices would be tempered?
Yes, that could help. Not every emerging market buys as much gold as every other
gold
one.
Being an exception for India.
But perhaps. And the important point there from our perspective is that many people have been buying gold, not necessarily in India, but globally they've been buying it for the wrong reasons. They've been buying it because they think banks are about to collapse, because they think there'll be hyperinflation. Neither of those things are likely to happen, so if monetary conditions normalise, gold could be vulnerable.
And what about oil?
Oil, we think, is a little bit better underpinned in the short term, because remember, there's a big cartel out there that helps to fix the price of oil. Not exactly, but it helps to fix it. Further down the road, I think the energy market's going to be very exciting, because things are changing quite dramatically on a longer term view. New technology is allowing us to get more carbon-based energy out of the ground. It's going to change not just the economics, it's going to change geopolitical risk longer term. But for the time being, we'd prefer the oil price to the gold price. We think it's got a better chance of standing firm in 2014.
What if inflation doesn't pick up in the US? The risk of deflation and overcapacity that stems in from China, how much of that can change the scenario completely?
It can change the short-term scenario quite considerably. The outgoing Fed chairman, of course, is worried about deflation. He's read a lot about, he's studied and written a lot about the Great Depression. My feeling is that actually we're probably overstating the fundamental damage that a little bit of deflation can do. There's not been an instance of significant deflation unaccompanied by a Great Depression. And if we have a Great Depression, I know which I'm going to be worrying about first.
What do you think will be the surprise for 2014?
So as we go into 2014, we think it's not Europe or the US, it's both of those markets continuing to lead the developed stock markets higher. There will be setbacks. Tapering is an obvious source of short-term volatility. But the underlying story, if we're right, is that the global economy is moving forward and valuations in the US and continental Europe are not yet sufficiently extended to stop people buying equities there.
All right, Kevin, we leave it at that. Thanks very much for taking out the time and speaking with us. So with that, we come to the end of this edition of Global Mantra Outlook 2014. Thanks very much for watching the show.
People have got so bearish about India and the rupee. And as you've just said with your question, it doesn't need a lot for things to get better. And so if you have that improving current account, and you have Modi, and you have a supportive cabinet, and you get a load of policies to boost FDI, you know, the rupee could be back in the mid-50s. It's not impossible.